As people move away from hourly billing, which as we know is a crazy way to price, and move towards value pricing, the first step in the process is we have to figure out, how do we give a fixed price? Because one of the things about hourly billing is that the customer doesn't know what the price is until we've added up the hours, done the work, looked at the timesheets, and then sent them a bill, which is a crazy way to price. So in this video, I'm going to share with you, how do you come up with a fixed price? How do you calculate a fixed price? Now, just to be clear on this, fixed pricing is not value pricing. However, it's an important first step. It's difficult to go straight from hourly billing to value pricing, particularly for compliance services like bookkeeping, cleanup work, tax returns. A great first step is to move to fixed pricing, to have a system. Then once you've got a system, it's relatively easy to add on the next levels, the next steps, to start turning that into a value pricing system. So how do we come up with a price? Let me explain the process that we go through. The first thing that you need to do is recognize that if you're giving a fixed price up front, you want to make sure you make a profit on the deal. You want to make a profit. And so you have to take into account scope. You have to understand the scope of the work, because the more work's involved, the longer it'll take, and therefore the greater the cost from your point of view. You have to do a great job at scoping work out. And for any service, there will always be one or two primary scope questions, scope factors. These are the things that have the biggest impact on what the price will be, how long the work will take. I'm going to use bookkeeping as an example. So for bookkeeping, it may well be the number of transactions. If it's payroll, it might be the number of employees. If it's annual financial statements, it could well be the size of the business, the turnover. So let's assume that we're bookkeeping, and let's assume that we decide that number of transactions is the primary scope factor. So what we need to do, if we want to create a system, a formula that we can use for pricing all future work, then the starting point is you want to have a look at your existing client base, how you've priced so far. And so you want to make sure that you create perhaps an Excel spreadsheet, pick 10 to 15 clients at random. You want to have at least 7 or 8 to make this meaningful, but you create, let's say, 10 clients. And for those 10 clients, what you want to do, get their details, and you want to find out what's the number for them for the primary scope question. So as you can see on the screen, let's say we have a client A, and client A has 10 transactions per month. So let's record the 10. Now, what is the price that you charge that client, or should charge that client? Based on your knowledge of that client, what should the price be? And it may be the annual fee is $960. What we do is we record that for a sample of clients. A random sample, 10 to 15 is a good number. So this takes about 10-15 minutes. Once we've done that, we can then plot those on a graph. And we can use something called regression analysis, which Excel makes really easy for you. Essentially, regression analysis means we can plot a line of best fit. And you can see that on the chart on the screen. We've got the line of best fit. Now, the line of best fit will never perfectly predict. There's never going to be a case where you create the line of best fit and all of your clients fit somewhere on the line. But we're not trying to get to perfection here, as I'll come on to in a short while. So what we do is, having got our line of best fit, what we can do with this is we can actually get a formula. There's a formula for this line that you can use. And that formula will be a good starting point. What you can get with that formula is something called an R-squared number, which is a number between 0 and 1. The closer to 1, the better the fit. So if you've got a line that's 0.8, 0.9, that's a pretty good fit. However, there will be clients that are far off the line. So as you can see here, if we look at client number H, you might then say to yourself, okay, so we've been charging that client $7,392, and yet the line's suggesting it should be $5,935. So why do we charge that client more? This is the second stage of your analysis. What you want to do is identify What are the secondary scope factors? So the primary might be the number of transactions per month, but other things that impact on scope, and therefore how much work is involved, might be how many bank accounts, how many credit card accounts, what industry are they in, do they have overseas transactions? Think about and identify the other scope questions. I recently did a research report where I studied 2,683 accounting professionals, and I asked them what were the most important scope questions when it comes to bookkeeping. And so on the screen there's some examples that you can use. Once you've got your secondary scope questions, what you then do with your analysis is you want to study and look for the outliers. Look at the clients where they're furthest away from that line. Like, for example, why is client number H you charging 7,392, and perhaps according to the line, according to the formula that's created, is it suggesting 5,935? It might be, for example, they have multiple bank accounts. It could be they have foreign currency transactions. What are the things about that client, based on your knowledge of them, means there's more work involved? And once you've then done that, you can start to, across your clients, do some analysis and say, okay, so these are the clients that are furthest away. How much do I feel I need to add or subtract to the price based on those secondary scope questions? And what you then end up doing, having done that, you can make some adjustments in Excel, and then you can rerun the regression analysis. And what you should find is the R-squared number goes up. You get a better fit. Now, you'll never get it perfect, and you're not looking for perfection. You're looking for something, a formula, that means that over a portfolio of clients, you know that your price will give you a profit overall. Sometimes a bit less, sometimes a bit more. Now, we can get it to another level by building in value pricing, but at least we've got a starting point now. We have a formula. And when you build in the secondary scope factors, you will end up getting close. You'll never get it perfect. You do not want it perfect. You don't need it perfect. And if you think about it, hourly pricing right now is not perfect. The thing that we love as a profession about keeping timesheets is it feels like it's accurate. We add the numbers up, we multiply by an hourly rate, and there's our price. But the trouble is, what happens in reality is, number one, where's the hourly rate come from? It's usually a made-up number. There's no science behind hourly rates. Let's not kid ourselves. Number two, realistically, how accurate are timesheets? They are not. When I used to work in the profession as a manager, as a senior, people often made up things. If they were running behind on a client and needed to get done fast, they'd work overtime, they'd work extra, and sometimes those hours wouldn't go on the timesheet because we wanted to make the numbers look good. Timesheets are not accurate. So we multiply this fictional made-up number by the number of hours that's made up. But then what happens is we then get to bill the client. We run off the work in progress report and we look at it and think, crikey, $7,000? The client's never going to pay that. Let's bill them $6,000. And we write time off. So this system that we think is accurate of recording hours and billing based on the hour is not, because of write-offs and inaccuracies. So don't worry if you create a process like this and have a structure of formula for giving fixed prices, where sometimes some clients we might get too high, sometimes too low. The important thing is, based on the regression analysis, you end up having a situation where, on average, over time, you will always make profit. And once you've got that in place, you can then build in, on top of that, some of the value pricing principles, where you then make sure every time you make a profit. If you want some more help on this area, I'll put some links below this video to some other free resources that you can get hold of. Go and grab those free resources, and I look forward to seeing you on another video. Bye for now.